On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day, team. Hope everyone's doing well. I wanted to talk today about the reporting season. We are right in the throes of the global reporting season finishing. Mostly all done now. A few more companies to go, but it's mostly behind us. And from this week and into next week, we will see the baton pass to the local market because the New Zealand reporting season really ramps up in the days ahead. We've got a couple of companies coming out this week with results, but next week things will get much, much busier. And over the balance of August and then into September, we'll see about 2/3 of the companies on our share market report their annual or their half yearly earnings results. And that is a really important period because it gives us a chance to take the pulse of corporate New Zealand, see how companies are going, hear the challenges that they're facing and the opportunities that they might see on the horizon. And it is a big driver of how share prices perform because you get a lot of new information that you didn't have before. So next week, we'll hear from Contact Energy, we'll hear from Fletcher Building, we'll hear from Scalar we'll hear from Spark, and then things will get much, much busier from then. But if we think overall, looking at those 2/3 of companies that are expected to report earnings, 6 out of 10 are expected or forecast to see profits improve on the previous year. And the median change is expected to be an increase of about 3%, but there's obviously a wide range of winners and losers either side of that. So there will be some quite big dispersion across the market, but overall, I guess you'd sort of look at that and you think maybe it's a little lackluster when you've got 6 out of 10 companies seeing profits go up. That means you've got 40% of the market seeing profits go down, which is quite a lot really. And a median increase of just 3% is a bit lackluster. I think if you were to do an average rather than a median, you'd be sort of looking at a flat return or even maybe a negative return because there will be a few companies that will see quite big decreases. But that shouldn't be any great surprise, especially when you consider where the economy is at. We have ran into increasing economic headwinds over the last 6 months. You've got higher interest rates, you've got the rise in cost of living. That's taken money out of our collective pockets as a society. So I think some of those businesses that are exposed to spending patterns or certainly discretionary spending might see softer numbers, and I'm thinking about the likes of KMD brands, which used to be Kathmandu. It's now much broader than just the Kathmandu brand. They've got Rip Curl, they've got other ones. So KMD brands sort of comes to mind. Michael Hill, the Warehouse, all of those companies I imagine would be feeling the pinch a little bit. Margins across the board will be under pressure for many, and what I mean by that is not only are companies battling with revenue growth or sales growth that isn't maybe as strong as it was when things were booming, but they've also seen costs going up. So they've had that squeeze where sales are down and costs are up, and that's sort of crimping profit margins or earnings margins. And Restaurant Brands was a very high profile release earlier this week where that company, Restaurant Brands, owns KFC, Taco Bell, Carl's Jr. So they're exposed to the consumer, although traditionally they are quite a defensive company because all of those fast food offerings certainly much cheaper than going to a cafe or a restaurant. but they're still facing some of those pressures, and rising ingredients costs, rising wage costs have impacted their earnings. So there was quite a hefty downgrade we saw from restaurant brands, and that is a bit of a shot across the bows. I think you might see other companies that are similarly under pressure. Lots of other businesses outside of that sort of consumer spending or retail space that are also quite tied to the economic cycle. And those are some of the companies that I'll be keeping an eye on too for any evidence of a slowdown. Companies like Freightways, Move Logistics, they tend to do well when there's lots going on in the economy, when there's lots happening. So with things having slowed a little bit, you might just see that come through in either their numbers. I think their numbers should look solid. For Freightways at least, the second half should be decent, but it'll be that outlook statement that I'll be keeping a close eye on. Are they cautious about what's coming up in the next 6 months, 12 months? What else we'll be keeping an eye on that sort of cautious side of the fence? Probably companies that are exposed to China will be worth watching. China is particularly challenged at present. It hasn't reopened in 2023 with the same vigor that we were hoping for, and that is flowing through to lower Chinese demand for many goods and services that other parts of the world supply to China. And for us, the agricultural sector is facing the brunt of this. You've had much weaker demand for dairy products, and that has pushed dairy prices down to almost 3-year lows. So the global dairy price is down 13 odd percent since the beginning of year. It's down about 40% from where it peaked last year, and admittedly that was a 15-year high. So it's come off a very high level, but it's still a hefty fall. And now we're back to levels we haven't seen for about 3 years. So that's why we saw that Fonterra downgrade last week, with their milk payout forecast being reduced from a midpoint of $8 to $7. That's a big deal. Don't underestimate how important that is, because a lot of farmers will actually not be able to cover their costs at $7. Their costs have gone up, the wage bill's gone up. If they're carrying debt, like many are, those borrowing costs have gone up substantially. So $7 is not great for a lot of farmers, and that will flow through to spending. That will flow through to the tax take for New Zealand. So it is quite a big deal. And I think when we consider some of those companies that are maybe exposed to either the dairy sector or Chinese demand, and I'm thinking about the likes of A2 Milk, Synlait, Scalar, which part of Scalarup's business is selling products to the dairy sector, to the industry. They might be affected, or at least we might see that caution come through in their guidance. So watching all of those ones too. Construction, probably the last sector where you've got a bit of a downbeat um, environment. So I think we'll see that come through in the earnings releases from the likes of Fletcher Building, Steel and Tube, Vulcan Steel. Just a lot of uncertainty in the sort of domestic market there. Things have tightened up, and that's been what we've heard from many of those entities anyway. So all of those ones are probably on the watch list for potentially negative news or cautious outlooks. That doesn't necessarily mean that their share prices will do badly, because remember, none of these things are a surprise, and many of those companies that I've mentioned have either come out and told us that times are tough, so it's out there in the open, or you've got analysts, you've got investors, you've got fund managers that are very aware of all these issues. So a lot of the time it's factored into those share prices. So don't just assume that, look, the construction sector, the retail sector is in a difficult spot, so all the results will be terrible and the share price reactions will lead to declines. Not necessarily. Sometimes you'll have a stock where everyone knows that they're facing challenges, and you'll get a result that is pretty bleak. But if it's not as bad as people were expecting, you can actually see a positive share price performance. So it's much more nuanced than simply sort of thinking about those that will be doing well and those that won't. But anyway, on the other side of the coin, look, it won't all be bad news. We've got several listed companies that could swing back into profitability quite strongly. And you think about the likes of Air New Zealand, Auckland Airport, Sky City, Tourism Holdings, Vista Group. Vista is exposed to sort of the cinemas and movie theatres. All of those companies, think back to a year ago, they were grappling with border closures, lockdowns, other sort of pandemic related disruptions. All of those things were making life really difficult for all of those businesses. And today, in August 2023, those clouds have well and truly lifted. So when you think about the first 6 months of calendar 2023 versus the first 6 months of last year, it'll be chalk and cheese. Last year would have been pretty terrible, not much happening at all. First 6 months of this year, maybe not back to the heyday pre-COVID, but certainly a lot better than we saw a year earlier. So I think you will see some big snapbacks in terms of profitability, and the headlines will look fantastic actually, because usually the headlines are comparing one period with the previous period, and at least in that sense, you will have some quite good returns to profitability, and maybe even the return of dividends from some businesses. Sky TV, another one to watch on the sort of positive side of the ledger, and this is a company that's had really challenging decade, to be honest. Used to be a very strong stalwart of the entertainment sort of spectrum, and sort of the way that we consume content. And then you had the advent of Netflix, and you have Amazon Prime, and you have all of those other range of different providers that have come in and disrupted the industry. So Sky TV has had a pretty tough ride. Spark Sports come in and taken the cricket and a few other sports. So life has got tougher, but the company is in a much more stable position these days. The new management team has done a great job of stabilizing things, so they're in a much better position than they were 3 or 4 years ago. And customer churn has subsided, so you're not seeing people switching. They've stabilized the customer base, got some of their key content locked in, improved some of the technology and the way that they sort of deliver their services. So I think that's probably one to watch when we think about companies that have maybe had a rough ride and have got things back on track. Then you've got all the reliable performers, lots of companies on our market. And we are quite lucky here in New Zealand because we have a low risk market, a defensive market that is dominated by utilities, infrastructure stocks, healthcare stocks, real estate stocks, good quality, low risk, steady, reliable performers, which is what a lot of investors are looking for. We don't tend to have as many high risk, exciting growth stocks, which is on the one hand a negative, but there's plenty of parts of the world that we can go to find those. And New Zealand does do a very good job in terms of our share market of delivering that reliable, steady growth in earnings and dividends. And that'll be the order of the day for companies like EBOS, Mercury, Meridian, Spark, Vector. Steady performance, solid but unspectacular is the way that I would describe some of those. EBOS will be an interesting one because they've obviously lost that contract that was very much in the news not so long ago. So that will be a headwind to how things are likely to develop for them in the next 6 months, 12 months. But in terms of the 2023 result that they'll be reporting, I think that will be very, very strong. So EBOS is maybe the one out of that group that I've just mentioned where you will have some swings and roundabouts. You'll get a great result. It'll look very, very steady, and it will be aligned with what we've come to expect from EBOS. But we just need to keep an eye on what they say about the future, because some people across the market believe that investors don't fully appreciate some of the headwinds that we might see impacting on margins for EBOS. The utility stocks, all the gentailers, Mercury, Meridian Energy, Genesis Energy, they should all report strong performances. We should all see them exceeding the prior year's profit. We've had good inflows into the lakes. That's translated to sort of strong production in terms of the renewable generation portfolio. So I think that sector is well positioned, and these companies all report their operational updates very regularly anyway. So it's very much a no surprises sector. And if you do have a view that interest rates have peaked and are maybe going to fall at some point over the next 12, 18 months, then, some of those dividend yields are probably starting to look attractive from a long-term perspective as well. Outlook commentaries, always watching these during a reporting season. They'll be very important to investors, and I think they'll be pretty muted. Management teams will be very aware of all the uncertainties out there. Are we going to fall into recession? Are we not? What's happening with China? What's happening with the US? Have we got inflation under control, or is there a bit more to come? Is the Reserve Bank done with their rate hikes, or are they going to have to move one more time? What's happening with the election? All of those things are keeping businesses a little bit cautious. So I think it's unlikely you'll see too many management teams that will go out on a limb and say, yep, this is where we think we'll be. They are likely to play their cards a little bit close to their chest, and I think they will err on the side of caution, just because of all of those things that are somewhat up in the air. But for all of that, there are bright spots. Costs are rising, and that'll come through in all the results. But we're definitely past the worst there. Inflation has peaked. It's coming down, not as quickly as we would like, not as quickly as the Reserve Bank would like, but it's definitely on the way down. You're starting to see some of those labour shortages begin to abate. And we saw that with last week's unemployment data, with the unemployment rate just ticking up a little bit and the labour market easing, got more people coming into the country. That's sort of helping things out. So that's good news, and that will continue, I would expect. House prices have stabilised. They fell very hard from late 2021 through to the middle of this year, but I think the falls are behind us and that they've now stabilised. They're not going to rocket away again in a hurry, but the fact that they are going sideways to slightly up rather than down is good for confidence. It's good for sentiment, and personally, I think interest rates are close to a peak. If I had to guess, I would say the Reserve Bank is done. I know there's a few economists out there that would disagree and say that there's at least one more rate hike in the pipeline, but I look at what's happening out there and the way things are tracking, and particularly when you add in that big downgrade from Fonterra from last week, I think we shouldn't underestimate how much of an impact that could have to the path of the economy over the next 6 or 12 months. So I think all of that does point to the Reserve Bank just staying put. But, who knows? That's my guess. We'll find out next week because the Reserve Bank's out next week too. The election's still creating some uncertainty there, and that's understandable. No one really wants to make any big decisions or any major changes or embark on any major growth plans or talk about those things when you don't really know who's going to be in charge and where the goalposts will be. But in a couple of short months, we can put that behind us and refocus on the task at hand. Recent polls do suggest that a change of government is looking increasingly likely, and I think that would be a positive for business confidence. Businesses do tend to favour a national-led government, and with all of the issues that we've seen over the last few years, I think there are many businesses out there that will be quite comfortable with a change of approach and a change of leadership in Wellington. So that's something else that we'll be keeping an eye on. And I guess the final positive is that the local share market has been relatively quiet this year. You haven't got huge expectations that are baked into share prices. The NZX 50 is up 4% in 2023. And remember, it's a gross index, so it includes dividends. So if you just look at share prices, take out dividends, it's less than 4. It's maybe 2.5 or 3 or thereabouts. So it's been solid, but far from stunning. Not up nearly as much as we've seen from Australia or the US or Europe. And we're still 12 or 13% below the peak that we saw in January 2021 and about 12 or 13% above the lows from June last year. So we've had a solid rebound, but it's got nothing on that 25% rally we've seen from world shares since they reached a bottom in October last year. So that means the bar is not quite as high as it would otherwise be. Still got a bit of caution out there, and our market has been a little soft, a little lackluster. So that's probably not a bad thing when you're going into a reporting season. It means that there is less room for disappointment. If we were up 10% this year or more, then you would be starting to get quite worried about some of these results that would disappoint everybody. But people are sort of already prepared for that. So that's important as well. But lots to keep an eye on. So enjoy that, over the next several weeks. It's through the rest of August and through September for some of those companies, like the retailers, like some of the agricultural companies that have a balance date at the end of July rather than June, as opposed to the majority. So it will be a bit of a staggered reporting season, but all through August, all through September, you'll get a string of results, and they will give us a great opportunity to take the pulse of corporate New Zealand and provide some real-time insights into where the economy is at and where it's headed. So if anything amongst all of that has caught your eye, or your ear, I should say, talk to your advisor. Obviously, none of those things I've mentioned are investment advice. I'm just talking generally about companies, what I'm expecting, what I'll be looking for. But that doesn't necessarily help you at all with knowing what you should own or not own, or sell or buy. You need to talk to your advisor about that. So don't take a sort of free to air podcast as the way to get your investment strategy. You actually need to get some good advice if that's what you're looking for. But hopefully some of those thoughts are useful, and hopefully that does sort of give you a few insights into some of the issues that are topical and that we'll be looking for as the reporting season progresses. So thanks for listening. We'll talk again soon.
For more insights, visit craigsip.com.